Hi, thanks for watching this video. Is it a bad idea to save money? Does it hurt the economy? Let's look at that today by looking at the loanable funds market. The loanable funds market is defined by loanable funds. The local funds are the amount of money that it's able to be loaned out, and it's usually done by banks or financial institutions. I like to remember this by saying loan and able are both in the definition, so that helps you remember. This brings together borrowers and lenders. Borrowers make up the demand curve and lenders make up the supply curve. Let's start with demand. Demand everyday items can be purchased with cash, but for big ticket items, you need to take out a loan. For example, if a business wants to add a new addition to their factory, it doesn't generate revenue yet, but how much they borrow depends on how much it costs to take out the loan that's adjusted for the inflation of real interest. If the price of the loan is really expensive, they're not going to borrow very much. But if the interest rate is low, they're going to borrow a whole lot more and maybe even invest in a bigger factory. But the demand of loanable funds doesn't just exist for businesses. It exists for us borrowing student loans. It exists for when you want to buy a house. It exists for medical bill loans if people can't pay the money. And it exists for a car loan. Let's talk about supply. The amount of money a bank can lend out depends on how much money people deposit into the bank. So the supply of loanable funds comes down to saving money, but not in a piggy bank or a jar at home. This money is deposited into the bank that's able to be lent out. This also includes foreign entities. The real interest rate is low. There's not going to be very much savings. The quantity of loanable funds is going to be small, but when the real interest rate goes up, the quantity that people will save is going to increase. And there will be more loanable funds supplied together. So together, the demand and supply for loanable funds sets the real interest rate, and that's the graph you're going to be able to draw and analyze the effects of borrowers in the demand curve. Anything affects the saver supply. Let's go back and answer the first question. Is saving money in a jar bad for the economy? Yes. But if you put it in a bank, it's going to actually help people. If you did this and save money, it's going to decrease in supply for the loanable funds market. Real interest rates will rise, and investment will go down, and the economy will be bad. If you put it in a bank, it'll increase in supply, real interest rates will fall, investment will rise, and the economic growth will also rise. Thanks for watching this video.